In this video, we will discuss the weighted average cost of capital, commonly called WACC. We will discuss both a WACC1 and a WACC2. The distinction between WACC1 and WACC2 is how is equity financed. For WACC1, we used retained earnings, RS. For WACC2, we use a new stock issue, RE. So WACC2, our cost of capital after we run out of retained earnings, will be higher than WACC1, the cost of capital for using retained earnings. For our example, we consider a company financed with 60% equity, 20% preferred stock, and the remaining amount with debt of 20%. We consider the cost of retained earnings of 12%, the cost of preferred stock of 8%, the cost of debt of 5%. Notice as risk increases here, the cost of financing increases, and a typical corporate tax rate, federal plus state, of 40%. All of these numbers are then stuck in the Excel version of our WACC formula here, where we use the fraction financed with debt times cost of debt times 1 minus the corporate tax rate, since interest payments can be written off on the taxes, plus the fraction financed with preferred stock times the cost of preferred stock, plus the fraction financed with equity times the cost of equity. We get a WACC1 of 9.4%. If we change the last term in here to the cost of a new stock issue being much higher at 17%, then our WACC goes from 9.4 to 12.4%. If we consider a company with a retained earnings of $50 million and an equity fraction of 60%, or 60% of the capital budget has to be financed with retained earnings, then we can calculate something called the retained earnings breakpoint, which is the retained earnings divided by the equity fraction. This is the point at which a company, if it has a capital budget above this, will run out of retained earnings and have to finance with a new stock issue. So this much can go to retained earnings, and the rest of 83 minus 50, or $33 million, would be financed with debt or preferred stock, and beyond that, you need more equity from another source. We can use this to determine whether the company would finance a project or not. We will look at projects A, B, C, and D with a project cost of $30 million, $20 million, $35 million, and $15 million. We rank these by their anticipated internal rates of return, the highest first of 15% for A, 13% for B, 11% for C, and 10% for D. And if we add up the project cost, we get the total capital budget of new capital for next year. First 30, then 30 plus 20 or 50, then 50 plus 35 or 85, then 85 plus 15 or 100. The retained earnings breakpoint of 83 would be right around the financing point for C. So if we financed project D, we would have to issue new stock. We can look at this graphically. Our capital budget will have a financing for WACC1 for the first 3 projects, but WACC2 for the final project. If the cost of capital WACC is less than the internal rate of return, which it is for projects A, B, and C, then we would engage in the projects because we would borrow at WACC, invest at IRR, and make money. For the final project D, we would be borrowing at a higher rate than we would be investing, therefore we would lose money and not engage in the project. Note in this case, if we had enough retained earnings, then WACC2 would be down here at WACC1, and we would probably still do project D. Thank you for watching this video.